$80,000. That's how much rising mortgage rates could cost first-time homebuyers who ignore the Federal Reserve's latest projections. This staggering figure might seem like an exaggeration, but as we dive into the specifics, you'll see that it's a very real possibility. In fact, according to a report by the Mortgage Bankers Association, the average 30-year fixed mortgage rate has been steadily increasing over the past year, with some forecasts suggesting it could reach as high as 7% by the end of the year. In the next 8 minutes, I'm going to show you exactly how interest rate increases translate to monthly payment shocks, reveal the specific numbers from Mortgage Bankers Association data, and show you the single biggest mistake first-time buyers make when timing their purchase decision. We'll explore case studies of real people who have been affected by rising mortgage rates and examine the strategies they use to mitigate the impact. By the end of this video, you'll have a clear understanding of how to navigate the complex world of mortgage rates and make an informed decision about your home purchase. First, let's take a closer look at how interest rates affect monthly mortgage payments. When you take out a mortgage, you're essentially borrowing money from a lender to purchase a home. The interest rate on your mortgage determines how much you'll pay each month in interest, and even small changes in the interest rate can add up to big differences in your monthly payment. For example, if you take out a $300,000 mortgage at 4% interest, your monthly payment would be around $1,432. But if the interest rate were to rise to 5%, your monthly payment would jump to $1,610. That's an extra $178 per month, or $2,136 per year. According to a survey by the National Association of Realtors, 70% of first-time homebuyers are unaware of the impact of rising interest rates on their monthly payments. This lack of understanding can lead to sticker shock when they see their monthly payment increase, and it can even cause them to abandon their home purchase plans altogether. As David Stevens, former CEO of the Mortgage Bankers Association, notes, rising interest rates can be a major obstacle for first-time homebuyers, who often have limited financial resources and may be stretching to qualify for a mortgage in the first place. One of the main reasons first-time buyers are so vulnerable to rising interest rates is that they often wait too long to make their purchase. According to a report by Zillow, the average first-time buyer waits around 2-3 years after initially considering purchasing a home before actually making an offer. During this time, interest rates can fluctuate significantly, and even small increases can add up to big differences in monthly payments. For example, if interest rates were to rise by just 1% over the course of 2 years, a first-time buyer who waited to purchase a $300,000 home would see their monthly payment increase by around $150. Another mistake first-time buyers make is not shopping around for the best mortgage rates. While it may seem like all mortgage rates are the same, the reality is that different lenders offer different rates, and even small differences can add up to big savings over the life of the loan. According to a report by LendingTree, borrowers who shop around for mortgage rates can save an average of $1,300 per year. As Greg McBride, chief financial analyst at Bankrate, notes, shopping around for mortgage rates is one of the simplest and most effective ways to save money on your mortgage. It's amazing how many people don't do it. Now let's talk about the single biggest mistake first-time buyers make when timing their purchase decision. This mistake is waiting for the perfect time to buy, whether that's when interest rates are at an all-time low or when the housing market is at a particular point in the cycle. The problem with this approach is that it's impossible to predict with certainty what the future will hold, and waiting for the perfect time to buy can often mean missing out on the current opportunity. As Lawrence, chief economist at the National Association of Realtors, notes, the best time to buy a home is when you're ready, not when the market is perfect. If you wait for the perfect time, you may end up waiting forever. So what's the one strategy that actually works to mitigate high mortgage rates? The answer is simple. It's to focus on the total cost of ownership rather than just the monthly payment. When you're shopping for a home, it's easy to get caught up in the excitement of finding the perfect property and forget about the long-term costs. But the reality is that the total cost of ownership, including mortgage payments, property taxes, insurance, and maintenance, is what really matters. By focusing on the total cost of ownership, you can make a more informed decision about whether a particular home is right for you, even if the interest rate is higher than you'd like. For example, let's say you're considering 2 different homes, one with a $300,000 price tag and a 5% interest rate, and another with a $250,000 price tag and a 4% interest rate. At first glance, the second home may seem like the better deal since the interest rate is lower. But when you factor in the total cost of ownership, including property taxes, insurance, and maintenance, you may find that the first home is actually the better value. As David Bach, author of The Automatic Millionaire, notes, the key to making smart financial decisions is to focus on the big picture, not just the monthly payment. When you look at the total cost of ownership, you can make a more informed decision about what's really important to you. In conclusion, rising mortgage rates can be a major obstacle for first-time homebuyers, but by understanding how interest rates affect monthly payments, shopping around for the best rates, and focusing on the total cost of ownership, you can mitigate the impact and make a smart decision about your home purchase. Remember, the best time to buy a home is when you're ready, not when the market is perfect. So, don't wait for the perfect time to buy. Start exploring your options today and make your dream of homeownership a reality. According to a report by the Urban Institute, the average first-time buyer who purchases a home at age 25 will have paid around $140,000 in interest over the life of the loan, compared to around $100,000 for a buyer who purchases at age 30. This highlights the importance of considering the long-term cost of homeownership when making a purchase decision. As Lisa Shed, a financial advisor at Northwestern Mutual, notes, the decision to buy a home is a long-term one, and it's essential to consider all the costs involved, not just the monthly payment. In addition to focusing on the total cost of ownership, first-time buyers should also consider working with a financial advisor to create a personalized plan for achieving their homeownership goals. This can help them navigate the complex world of mortgage rates and make a more informed decision about their home purchase. As Michael Sheldon, a financial advisor at Charles Schwab, notes, a financial advisor can help you create a plan that takes into account your individual circumstances and goals, and can provide valuable guidance and support throughout the home buying process. By following these tips and being mindful of the potential pitfalls, first-time buyers can navigate the challenges of rising mortgage rates and achieve their dream of homeownership. Whether you're a seasoned investor or a first-time buyer, the key to success is to stay informed, be patient, and focus on the big picture. As the Federal Reserve continues to adjust interest rates in response to economic conditions, it's essential to stay up to date on the latest developments and adjust your strategy accordingly. In the final minutes of this video, I want to summarize the key takeaways and provide some additional resources for first-time buyers who are looking to learn more about navigating the world of mortgage rates. Remember, the $80,000 figure I mentioned at the beginning of this video is a real possibility, but it's not inevitable. By being informed, being patient, and focusing on the total cost of ownership, you can mitigate the impact.